Welcome to the Lerner Group's Moving Markets monthly podcast. I am Michael Schneider and always joined by J.R. Gondek. And today we are going to discuss inflation. It's been the topic of conversation the last month or so, and we really think it's something that is having a significant impact on the economy. And, inflation, I think, basically is just the rise of, consumer prices over time. J.R., can you dive into really how it's measured and what we're really looking at?
Yeah, its basic definition, it's too many dollars chasing too few goods. And we see that playing out in so many different industries right now. And the Federal Reserve met this past month and they talk about inflation being transitory and they're not overly concerned. And really what they're talking about is the year-over-year change from the pandemic shutdown last year. Year-over-year inflation numbers are up a lot. And they think that the numbers are going to slow down as we get to the summer and the fall. And most likely they're right because of how they measure it. And again, we always remind you to think about consumer price index. 1/3 of the index are rents in housing. So it doesn't include a lot of the inflation that we've all seen. So when you look at the official numbers, you're likely to see the CPI numbers really slow down to the summer and fall.
So do you think that the number is actually going to be understated then, based on what you just said?
Well, our concern overall is with the Fed, because the Fed's always been our best long-term guide. When the Fed is stimulating, in general, we'd like to lean a little more opportunistic or more growth-oriented. And at this stage of the recovery, we really think the Fed should be tightening and not raising interest rates, but slow down how much money they're printing, tapering, so to speak, as they call it. And the Fed is just not likely to taper based on their comments. And really, when you look at the inflation, we see three main areas that have had significant price appreciation or inflation, right? Stock prices over the last 15 plus months are up substantially. They're not included in consumer price index. Housing prices are up substantially. And we'll talk about that a little bit more in a second. And then you've had this new phenomenon, cryptocurrency. It's up 1,000% in the last year, right? You've gone from relatively small amount to a couple trillion now is there. And all of that inflation or price appreciation is outside of what the Fed is watching or commenting on at this point. And that's where we don't see the need to print as much money. We really believe the Fed should be thinking about tapering at this stage because it is a concern that as they continue to print, it's feeling more appreciation in stock prices, housing, and crypto as we look at it.
And I agree with that, JR. And when you look at sort of the Fed's historical statements, they said that really in around 2023 is when they want to ideally start raising rates. If you talk about tapering, and it's not as though we're turning off the spigot completely. Say we're printing 120 billion a month. If we just bring it down, say 5 billion a month, that still gives you a 2-year window to get down to zero to when you can start raising rates again in 2023, kind of keeping with the Fed's stated goal anyways.
And having said that, I mean, our job as we look at it with rebalancing and asset allocating is given what the Fed's doing, where's the opportunity? Yeah. And as we think about it with where the Fed is going with their policies, they're sort of going to encourage open inflation in certain parts. So if we think about some of the commodity markets overall, and Michael, I think you had some comments on quarterly earnings specifically in some of the commodity areas.
Yeah, for sure. A lot of the just raw material producers, whether it's aluminum companies or gold and copper miners, are just knocking it out of the park. Aluminum revenues are up 100% year over year. Gold and copper are up 70% year over year. And what's been the most beneficial thing for them is just the demand, the price appreciation, and not having any additional overhead to pull the material out of the ground. All that extra profit goes straight to the bottom line for them. And it's been a tremendous opportunity for us. And we think that it's going to continue to move in that direction.
On top of it, when you look at the success there, dividends, we've been talking about 2021 being most likely a record dividend year for companies returning cash to shareholders. And the commodity area is likely to see a big cash flow return over the second half of the year.
And one other area that I think is going to do well is really the semiconductor space. I think a lot of people have been hearing about the shortages in chips, whether it's for, cars, whether it's, for your refrigerator, whether it's for all these different appliances that never had computer chips before. There's just this excess demand out there. And we think there's going to be a tremendous amount of opportunity. And what's interesting about, the car companies is that, historically you've always said, what's the last model year price? Maybe it's a little bit lower than what the current model year is. And with inventory so low, that discount's gone. I think that just sort of adds again to the inflation story and adds to car companies' sort of bottom line without, again, any additional overhead on their side.
Yeah, and when you look at the car companies overall in the auto sector, given the demand, I mean, we had April car sales a new record, right? So you continue to see a lot of money looking to buy. But with the chip shortages, as you're talking about, you could see a situation in the third and fourth quarter where there's little to no new car inventory on any lot. And it's going to be these kinds of things to watch for as we look to the second half of the year, that you're going to continue to have these supply chain issues overall in the semiconductor and chip space is exactly one of those issues we're watching.
And I think one other interesting note about this chip shortage is when you look at how companies reinvest in themselves to either bring more product online or improve the supply chain, that you haven't seen a lot of that with some of these ancillary industries, but really the semiconductor space, you've seen companies start building new plants and trying to get more chips online. I think it's interesting because when you look at sort of that core component of a lot of goods that we use, that demand is not going away, which a lot of other industries you just really don't know. But in the chip space, I'd say seems like a pretty good idea that demand is going to continue for the foreseeable future.
And that's a great trend overall, is capital expenditures looking not at next quarter's earnings or next quarter's revenue, but really looking out a few years, build out that capacity. So we believe the companies that are looking a little bit intermediate and longer term and building out the capacity will be very well positioned with a lot of upside over the next few quarters.
Okay. And as we talk about sort of the next few quarters, as we look at, they kind of have a year-end forecast, I think one of our concerns is sort of a moratorium on collections, whether it's for mortgages, rents, student loans. As people have to begin paying those bills again, do you think you could see a slowdown in the economy just from those payments starting up again?
Well, it's going to be a challenge for the Biden administration as you look toward those issues, because it's a real issue for a lot of people. I mean, the pandemic is not over. I mean, there's still a lot of jobs that have yet to come back. And again, a lot of with what we're talking about Federal Reserve policy, by printing 120 billion a month, it doesn't speed up the vaccination process at all or the implementation by states. We need to be patient, let the states reopen, let everything recover, and the jobs will come back. So as you get to September and October, where that moratorium, and you could see cash flow for individual consumers get hurt again, because you'll have to start making a lot of those payments that have been kind of in a moratorium for the last year and a half by that point. So we're really going to be watching consumer spending in the fall, as well as the administration, to see if there's a fourth stimulus, for example, or other commentary around that to really help kind of navigate consumers until we're fully recovered on the overall economy.
And if we're looking out from that perspective, at 3-4 quarters, if we're looking kind of at the immediate right now, we're in the midst of sort of first quarter earnings season. And one interesting thing we've noticed is that we've had a lot of your big tech companies just, crush earnings, but the stock price hasn't really moved relative to those big beats. And I think that's a big indicator too of what we've been talking about over the past few months, of this rotation out of big tech, where investors are looking for, greater marginal return and sort of divesting from those big companies. We've seen, again, a lot of movement into the value stocks, into a lot of these inflation trades, a lot of the commodity names. And I think really, from our perspective, until the Fed really changes its tune, we got to play that hand that we're dealt. We got to really stay with what's going to be in the best interest of our clients. And on the from an investment standpoint, I don't really see a reason to back away from that idea.
Yeah, the risk reward, and when you look historically at inflationary periods like we seem to be in at this point, the value stocks really outperform, and it's being confirmed, as you said, Michael, with the earnings season, because the results have been fantastic on a lot of the big tech overall. There's just better opportunity looking at everything else in the value sector with dividends. So it continues to be a good way, we think, to protect your portfolio, and that cash flow of what's ahead should play out pretty well over the next few quarters.
All right, well, I hope it does. So again, I want to thank everybody for joining us today. If you have any questions or any comments, please feel free to reach out to us at the Learner Group, and we look forward to seeing you all next month. Thanks so much.